There are laws that govern the world long before human beings learn to name them. Gravity pulls the river toward the sea, and time bends all ambition into humility. Among these invisible laws, there is one that rules over every fortune ever built, every civilization that dared to grow: the law of compounding. It is not loud. It does not dazzle. It does not rush. It moves as the seasons move, steady, patient, indifferent to applause. Compounding is not a trick of finance. It is a pattern of existence. It is the quiet rhythm through which life multiplies itself. A drop becoming a stream, a seed becoming a forest, an idea becoming a legacy. Those who understand it bow to it as one bows to weather, not in fear, but in respect. But compounding has one mortal enemy: interruption. And most interruptions are not accidents of fate. They are acts of human impatience. In every age, people have mistaken motion for progress. They leap from venture to venture, belief to belief, fortune to fortune, convinced that speed is intelligence and excitement is success. But compounding rewards only the still and the disciplined. It feeds on time, not brilliance; on endurance, not enthusiasm. To survive is to let time work for you. To interrupt is to make time your enemy. The difference between the rich and the ruined, between wisdom and regret, often lies in how one treats the slow miracle of persistence. Those who keep their heads when others are seduced by novelty. They are not merely lucky. They are obeying nature's oldest law. The rule is simple enough to be mocked and too deep to be improved upon. Don't lose. Not because loss is immoral, but because recovery consumes lifetimes. Every setback interrupts the rhythm of compounding. The small daily returns that over years bloom into something vast and unrepeatable. A person who loses half his fortune must double it to return to where he began. A person who keeps what he has, even modestly, is already running faster than those who chase. So the rule is not an order to win. It is a command to endure. Survival is underrated. In business, in investing, in life itself, survival is the highest form of intelligence. The fool chases triumph. The wise man avoids ruin. The difference is subtle, invisible at first. One takes risks to prove his cleverness. The other takes precautions to preserve his peace. In time, the clever fade, consumed by the very risks that once made them bold. The patient remain, growing slowly, quietly, until what was small becomes enormous. This is the paradox of endurance. Those who seek safety outlast those who seek victory. And in the long run, outlasting is victory. Compounding rewards character more than calculation. It favors those who can sit through boredom without reaching for destruction. It honors restraint, the ability to say no when every impulse screams yes. To not lose, this is not cowardice. It is wisdom distilled. The wise understand that time does the heavy lifting. The foolish insist on doing it themselves. The first rule, then, is not about money. It is about temperament. About knowing that survival is not passive. It is active patience. The discipline to resist interruption. When one truly understands compounding, one stops asking, "How can I get more?" and begins asking, "How can I avoid losing what I already have?" In the end, the world belongs not to the swift, but to the steady. Not to those who win the loudest victories, but to those who make the fewest fatal mistakes. Time is the partner of the patient and the executioner of the reckless. The universe does not care who is clever. It only cares who lasts. And so, whispered beneath all the noise of ambition, one quiet truth endures. The rule that never changes: don't lose. Because those who don't lose, eventually, win everything that matters. In the stillness of memory, there are winters that never quite melt. Omaha, 1930s. Streets dusted with frost and silence. The laughter of prosperity had vanished. Banks shuttered their windows like coffins, and proud men carried their dignity in paper sacks. It was not a story about economics. It was a story about human nature stripped bare. Families who once owned businesses now traded their furniture for bread. Children learned to read the language of worry in their parents' faces. The city, once full of motion, slowed into a kind of stunned humility. The lesson was written everywhere, on ledgers, on doorways, in the empty eyes of those who had borrowed too much from a future that never arrived. Scarcity is a ruthless teacher. It does not lecture, it demonstrates. It reveals what optimism conceals, that everything solid can vanish, and that progress, like comfort, is reversible. The Great Depression was not merely an economic event, it was a psychological one. It stripped away illusions of permanence. It taught a generation that wealth is fragile, confidence is temporary, and survival is sacred. Those who lived through it learned to distrust excess, to respect cash, and to measure security not in numbers, but in durability. For them, risk was not a statistic. It was hunger. It was the sight of fathers walking 10 miles to find work that did not exist. The arrogance of the 1920s had been swept away. A decade of champagne and speculation washed into the dust. Everyone had believed the future would continue to smile. The factories would hum forever. The stocks would rise forever. The banks would never fail. But optimism, unchecked, is a form of blindness. It sees only the sun, never the shadow. When the reckoning came, it did not arrive like a thief. It arrived like gravity, natural, inevitable, and devastating. Those who had borrowed against tomorrow discovered that tomorrow had defaulted, and those who had saved, quietly, cautiously, became the new survivors of a fallen world. Prudence was born from ruin. In times of plenty, prudence seems timid. In times of famine, it is divine. From those years emerged a generation who counted pennies not from greed, but from memory. They saved not because they loved money, but because they remembered the taste of fear. They learned that security is not built on optimism, but on discipline, on the refusal to assume that good times will last. The wise began to see survival not as defeat, but as victory. To stay solvent when others vanished became a triumph of character. Optimism is intoxicating. It makes risk look like courage. But when scarcity teaches, the intoxication fades. One learns to ask quieter questions. How much could I lose? What would I do if everything stopped working? What would it take to survive the winter? Survival, after all, is the foundation of every dream. Without it, even brilliance is worthless. Those who came of age in that cold era carried the lesson for the rest of their lives. They distrusted easy promises. They believed in cash in hand, not numbers on a page. They kept margins of safety in everything, not just in investments, but in living. And perhaps that was the hidden gift of those hard years. Prudence became a form of love. It was a way of protecting one's family, one's dignity, one's peace of mind. To be careful was not to be fearful. It was to be faithful to memory. History forgets the faces, but not the pattern. Each generation thinks it has escaped the gravity of scarcity until the cycle returns. Then the old lessons reappear, whispering through the ruins. Save more than you spend. Borrow less than you can. Survive longer than you expect. These are not merely financial truths. They are spiritual ones. Because beneath the charts and crises, beneath all the noise of progress and collapse, one truth remains. The world belongs to those who remember what it means to have nothing. For in the end, It is not optimism that sustains civilization. It is endurance. The bright-eyed dreamers build the future, yes, but the cautious keep it from collapsing. And it is from them, the survivors of hard times, that the next chapter of wisdom always begins. History never repeats itself exactly. It rhymes softly, like an old song the world cannot stop humming. And in the 1970s, that song returned. The Great Depression had faded into myth, but its ghosts were patient. They watched as a new generation, confident and unscarred, began to make the same mistakes under a different name. The lesson of scarcity had softened into the illusion of mastery. Prosperity, once earned, was now assumed to be permanent. The air smelled of progress, new machines, new systems, new certainties. But beneath that fragrance, the same old rot was spreading. Inflation rose like an invisible tide, slow at first, then relentless. Money, once trusted, once stable, began to betray its keepers. Prices climbed without mercy. Savings melted quietly in drawers and bank accounts. The ordinary man, who had done everything right, watched his labor become worth less each month. It was as though time itself had turned against him. Governments tried to control it with promises. Economists tried to explain it with theories. But inflation is not just an economic disease. It is a moral one. It punishes prudence and rewards recklessness. It makes the patient look foolish and the gamblers look brave. And when confusion spreads, greed dresses itself as progress. The 1970s became an age of illusion, a decade of clever men mistaking speculation for innovation. They built castles of paper and called them wealth. Everyone wanted to outsmart time rather than cooperate with it. Fortunes rose like fireworks, bright, brief, and forgotten. The markets swung like pendulums, feverish with hope one moment and despair the next. In that chaos, the wise looked foolish again. They held cash. They stayed patient. They refused to chase the crowd. They were mocked for their caution, called outdated, conservative, unimaginative. Yet when the smoke cleared, only the conservative were still standing. To stay conservative when others lose control is not merely prudence. It is courage of the quietest kind. It is the courage to stand still while the world runs in circles, to be laughed at for being early, and then envied for being right. The inflation years proved what history always whispers. Greed has infinite disguises. Sometimes it calls itself ambition, sometimes innovation, sometimes reform. But it always ends the same way, with people discovering that reality cannot be negotiated. When a dollar buys less each year, when speculation consumes savings, when everyone starts believing that this time is different, it never is. It is only the same story, retold by new actors. The wise of that era learned again what their elders already knew. Progress is not measured by movement, but by durability. To move fast is easy. To endure is divine. They saw fortunes collapse that had been built on excitement, and quiet wealth endure that had been built on discipline. They saw that the future belongs not to the loud, but to the liquid. To those who can stay calm when the air thickens with panic. In those years, many rediscovered the beauty of simplicity. Businesses that made things people needed. Investments that didn't depend on miracles. Lives that could continue even when prices changed and systems failed. The cycle of illusion and awakening had played out again. And as always, the survivors were those who remembered that greed always begins as optimism. That progress without restraint becomes destruction. That the past never disappears. It only waits for the arrogant to forget. History, it seems, is not written by the brilliant, but by the cautious who live long enough to see the cycle complete. And as the 1970s gave way to another new dawn, The lesson remained unchanged. Stay conservative when others lose control. Because in a world forever chasing the next miracle, sanity itself becomes a form of genius. There is a subtle poison that no crisis can match, a peril that lives quietly in the human heart, invisible until it has done its work. It is called envy, the quiet, unrelenting dissatisfaction born not from want, but from comparison. Envy is a peculiar sin. It tastes of bitterness and discontent, yet promises no pleasure. Unlike lust, which has its fleeting delights, or pride, which warms for a moment, envy is cold. It gnaws in silence, leaving its victims restless, miserable, and reckless. The psychology of envy is simple, and yet profound. We measure ourselves against others rather than against reality. A neighbor's house is slightly larger, a classmate's career slightly faster, a colleague's fortune slightly greater. And suddenly, the mind forgets its own achievements. Satisfaction becomes a distant memory. The eyes, once content, turn outward. The heart, once steady, becomes a compass pointing always toward what others have. And when that happens, judgment fails. The content mind knows restraint. The envious mind chases what it cannot reach. In markets, envy is one of the deadliest impulses. It convinces the cautious to leap, the patient to gamble, and the prudent to abandon principles for the sake of appearances. History is filled with the echoes of envy. The tech stocks of the late 1990s, real estate frenzies in the mid-2000s, the rise of speculative bubbles in countless markets. Different years, different actors, same fatal pattern. Those who were satisfied with their own method watched as the envious hurled themselves into risk, believing imitation to be wisdom. Copying others in this sense is the surest route to ruin. To mimic another's success without understanding the foundation beneath it is to build on sand. And when the tide rises, as it inevitably does, all that imitation collapses. Envy is not only destructive to wealth, it is corrosive to life itself. Men have earned fortunes only to find themselves hollowed out by the quiet knowledge that someone else had earned more. They bought yachts, houses, and luxuries, but could not enjoy them because the mind remained fixed on what was beyond reach. It is a strange form of slavery. One's happiness is tied to another's performance. One's courage is measured by comparison, one's success by the mirror of someone else's fortune. And in that mirror, nothing appears large enough, nothing permanent enough to satisfy. The antidote to envy is simple, though difficult in practice. Stop measuring yourself against the scoreboard of others. Return to your own game. Focus on what is within your control, not on what is beyond it. The patient understand that their wealth, their achievements, and their time are cumulative, the product of consistency, patience, and endurance. They do not need to leap to match someone else's rise. They only need to avoid the catastrophes that envy tempts others to embrace. Consider the paradox. Those who appear foolish for not chasing the crowd often end up wiser than those who follow it. In the dot-com era, when fortunes multiplied overnight, the envious were dazzled, eager to emulate without understanding. When the bubble burst, the steady, patient investors were left standing while others were exposed naked to ruin. This is envy's cruel lesson. The brief thrill of imitation can feel like brilliance, but the cost of exposure is permanent. The mind that envies loses clarity. The portfolio that chases loses stability. Contentment is not complacency. It is recognition. It is the courage to sit still while others panic, to refuse the temptation to compare, to let the long game play out while the impatient chase illusions, to survive, in markets, in life, in fortune, One must cultivate this quiet discipline. One must train the heart to be satisfied with its own journey, even as others race, stumble, and fall. Envy is the enemy within. It does not announce itself with warning bells. It whispers, subtly, persistently, until the prudent are seduced into folly. But those who resist it, those who focus on their own principles rather than the gains of others, discover a remarkable truth. The only race that matters is the one you run yourself. And in that race, patience, prudence, and avoidance of envy become the quiet architects of fortune. There is a kind of false brilliance that tempts the mind, the belief that cheap is clever, that bargains are wisdom incarnate. It is a seductive whisper, promising profit for the price of attention. And yet, it is a siren, leading even the careful to rocks unseen. In investing, as in life, there are what some call cigar butt opportunities. Companies that appear nearly exhausted, offering a last puff of value before they expire. One imagines a final windfall, a stroke of cleverness that rewards boldness. The mind delights in the simplicity. Pick the discarded, claim the overlooked, and profit where others have failed. But the reality is never so clean. The cheap remains cheap for a reason. A business that has decayed will continue to decay. A bargain that looks brilliant in a spreadsheet may hide rot invisible to casual inspection. One puff, perhaps, and then nothing remains but smoke. The cost of chasing these illusions is not measured merely in money lost, though the losses can be large. It is measured in time squandered, in opportunities forgone, in the years that could have been devoted to nurturing something enduring. Value and price are not synonymous. A low price is seductive, a high price is intimidating. Yet true value is found not in cost, but in quality, durability, and the ability to compound over time. A great business, even purchased at a fair price, becomes a fortress of growth. A mediocre business, even at a bargain, is a trap for patience and ambition alike. The mind that confuses cheapness for cleverness mistakes the ease of acquisition for wisdom. It forgets that the universe does not reward shortcuts. It rewards endurance, insight, and restraint. There is humility in recognizing that true opportunity is not measured by how low the price falls, but by how high the business can rise if left alone. To wait is to trust in time, to accept that small gains compounded quietly over decades surpass the fleeting thrill of a bargain bought and sold within a year. This lesson is hard-won. The temptation to be clever, to outsmart the market, to seize what appears abandoned, is nearly universal. Yet, it is also nearly universal that those who give in to it will later recount the regret. The smoke that seemed free leaves a stench that lingers long after the investment has faded. The illusion of cheapness is not merely financial, it is philosophical. It appeals to the vanity that believes intelligence is measured by the swiftness of action rather than the wisdom of restraint. It tells the impatient that they are cunning, that they are seizing advantage, that brilliance lies in action. The truth, however, is the opposite. Brilliance lies in avoidance of folly. It lies in resisting the seduction of the bargain, and instead investing in substance, in quality, in time-tested endurance. The long-term cost of short-term gains is rarely immediate. It is measured in years, in the slow erosion of opportunities, lost while one chases fleeting rewards. And it is measured in character. The patience that is trained in waiting is stronger than the cunning trained in cleverness. To pay a fair price for a great business is not indulgence, it is strategy. To chase a cheap business that offers only smoke is not cleverness, it is illusion. The lesson is clear. Resist the lure of superficial bargains. Understand the difference between a price and a value. Recognize that in the quiet compound of a great business, time itself becomes a partner. while in the pursuit of discarded scraps, time is the enemy. The world rewards the patient and punishes the impatient. It rewards the discerning and exposes the clever but foolish. In the end, the price of avoiding stupidity is far lower than the cost of fixing it. And in a universe ruled by compounding, that distinction is the difference between ruin and quiet, enduring fortune. There is a peculiar power in admitting what one does not know. In a world that glorifies certainty and worships brilliance, humility is often mistaken for weakness. Yet true strength lies not in the audacity to know everything, but in the courage to recognize the boundaries of one's understanding. In investing, as in life, the temptation to overreach is endless. Markets, technologies, and industries present themselves as puzzles to be solved, mysteries to be conquered. The mind swells with confidence, and suddenly the investor believes he can master the entire world, oil, tech, currencies, and more, in a single afternoon of study. This is the illusion of competence. It feels exhilarating, it feels necessary, but it is also fatal. Overconfidence is one of the most consistent killers of fortune. It blinds, it hurries, and it convinces the intelligent that they are infallible. Those who overreach act boldly, believing that audacity alone is a strategy. And when the tides turn, as they always do, they are exposed, naked, unprepared, and humbled. By contrast, humility is the quiet genius of survival. It begins with the recognition that no one can know everything, and that life, like markets, is infinitely complex. It accepts that uncertainty is the rule, not the exception. It understands that the safest decisions are often those that do not require omniscience. The concept is simple, though counterintuitive. One must stay within one's circle of competence. Invest only in what one understands deeply. Avoid what lies beyond grasp. Resist the temptation to swing at every pitch, and instead wait for those that fall squarely within reach. Admitting ignorance is not defeat, it is preservation. It allows one to live to invest another day. It prevents catastrophic mistakes born of hubris. It is the difference between doubling down on a failing idea and stepping aside before the loss becomes permanent. Some may call it dull. Some may mock it as timid. But over decades, it is this very restraint that compounds quietly, invisibly, into enduring success. Consider industries filled with complexity, where failure is routine and knowledge fleeting. Airlines, oil exploration, emerging technologies. Those who ventured recklessly often paid a permanent price. Those who admitted their limits survived, learned, and returned to the fray on their own terms. This is the quiet paradox. The less one pretends to know, the more one can endure. The less one overreaches, the more one's patience is rewarded. The less one chases every shiny opportunity, the more one gains from the few that truly matter. Humility also preserves judgment. It guards against the seductive voice of the crowd, the hype of novelty, the allure of the next hot idea. It anchors the mind in principle rather than impulse. And in doing so, it multiplies the value of patience and the power of compounding. To know less, in this sense, is to know enough. It is to understand that life, like the market, is a vast, complex, and often unforgiving teacher. One cannot master every lesson at once. One must master the rules that matter most: prudence, patience, and avoidance of the catastrophic. The wisdom of knowing less is also moral. It tempers pride, curbs envy, and shields the investor from the self-destructive urge to impress. It allows one to resist the siren call of speculation and to focus on what is within reach. In a world that rewards the flashy, the overconfident, and the reckless, this restraint appears boring. Yet history proves it is far more profitable than brilliance alone. Ultimately, the strength of restraint, The courage to stay within one's circle, and the humility to admit ignorance are not just strategies for investing. They are strategies for life. They are shields against the inevitable storms, guides through uncertainty, and compounding agents of fortune, both financial and moral. The universe rewards patience, not audacity. It rewards clarity, not hubris. And those who know the limits of their knowledge and respect them endure when the rest are swept away. In the landscape of wealth and enterprise, there are two kinds of thinkers: the careerist and the owner. At first glance, their goals may seem aligned, their work indistinguishable. But the distinction lies not in effort, but in horizon, not in ambition, but in orientation. The careerist measures success by applause, recognition, or the immediate rewards of the next quarter. Bonuses, promotions, accolades, these are their compass. They optimize for what can be shown today, rarely questioning the long-term consequences of their choices. The owner, by contrast, thinks in decades. Their currency is durability. Their focus is not on fleeting appearances, but on enduring value. They build systems, cultivate culture, and preserve capital not for headlines, but for generations. Incentives shape behavior more profoundly than knowledge or intelligence. A careerist may steer a company into risky ventures to impress analysts, expand empires to inflate titles, or cut corners to meet quarterly targets. The logic is simple. Rewards come now. Consequences may arrive years later, if at all. An owner, however, asks a different question. Will this decision strengthen the foundation for the decades ahead? This lens changes everything. The choice to maintain loyal customers, invest in quality, or protect the brand may appear conservative in the moment. But over time, it compounds into resilience and sustainable wealth. The contrast is visible in countless examples. In the corporate world, companies run by careerists chase size and spectacle, prioritizing optics over substance. They acquire businesses to enlarge their empires, inflate salaries, or signal prowess, often at the cost of long-term viability. Owners, by contrast, sacrifice immediate comfort to safeguard the future. They understand that reputation, culture, and capital are cumulative assets to be preserved and nurtured. A decision that looks boring or slow today may, in truth, become the source of monumental compounding tomorrow. The owner's mindset is also a matter of patience. It resists the siren call of the next trend, the pressure to act before understanding, the impulse to match the pace of others. It sees time not as a constraint, but as an ally. It understands that a well-chosen investment held for decades far outweighs the thrill of a short-term triumph. The lesson is subtle, but profound. Think like an owner, not a transient participant. Ask each time you invest, each time you make a decision, each time you trust a business. Are these people acting as owners or as careerists? If the answer is owner, patience will reward you. If the answer is careerist, beware. The structure may crumble once the incentives shift, once the next bonus is paid, once the quarter ends. Ownership is a mindset that extends beyond numbers. It is ethical, practical, and strategic. It is the willingness to defer gratification, to accept temporary invisibility, to hold ground when everyone else chases applause. And in a world that glorifies the flashy and immediate, that patience, that refusal to be seduced by ephemeral success, is rare. Yet rarity is the source of power. Owners survive when others fall. They endure through recessions, bubbles, and crises because their vision is anchored in longevity, not immediate recognition. Ultimately, the owner's mindset teaches a simple principle. Your focus should be on building and preserving, not on showing off, not on keeping up, not on racing for the next quarter. The rewards of this mindset are invisible at first. They do not arrive in headlines or weekly charts. They arrive quietly, steadily, through the compounding of good decisions, the avoidance of ruin, and the cultivation of trust. And in the grand arc of time, it is this quiet accumulation, the patient stewardship of capital, relationships, and principle, that separates the enduring from the ephemeral. In the pursuit of wealth, there are subtle dangers that far outweigh the obvious risks. They do not announce themselves with sirens or alarms. They do not appear as towering waves in the markets. Instead, they creep quietly, patiently, and when ignored, they can destroy even the most disciplined investor. These are the three enemies: debt, drama, and dumb company. Debt is the first. It is a loaded gun that sits quietly in your life, invisible until the moment it fires. In good times, debt seems benign, even clever, a tool to leverage opportunity, to accelerate gains. But in truth, it is a sword suspended by a thread. One misstep, one market downturn, one unexpected event, and the borrower is exposed. History is replete with examples. Families wiped out during the Great Depression, investors ruined in the bear market of the 1970s, banks collapsing in 2008, all victims of overreach, all seduced by the temporary illusion that tomorrow would always resemble today. Debt magnifies everything. The gains, yes, but the losses even more. And the cost is often dignity as much as money. The lesson is immutable. Avoid debt that cannot be repaid. Live within your means. Let patience, not leverage, do the compounding. Drama is the second enemy. It comes not as destruction, but as distraction. Entire fortunes have been lost to the allure of excitement, to the seductive pull of chaos, to the human craving for thrill. Drama clouds judgment, wastes energy, and blinds even the most disciplined mind to simple truths. I have seen entire companies collapse not because of competition or market forces, but because of feuds, conflicts, and needless conflict among leaders. Investors ruin themselves chasing schemes that promise immediate action, immediate gains, immediate gratification. Drama seduces the mind into thinking complexity is intelligence, noise is opportunity, and chaos is progress. The antidote is simplicity. Business should be boring. Investing should be boring. Excitement is the enemy of patience, and patience is the only reliable path to compounding. Dumb company is the third, the silent poison of partnership and association. No market volatility can match the destruction wrought by incompetent, dishonest, or reckless collaborators. One bad partner, one careless executive, one immoral manager can undo decades of prudence and patience. History provides cautionary tales. The Salomon Brothers scandal of 1991, where a single trader's recklessness nearly sank an entire firm. Countless other examples where ambition, cunning, or incompetence destroyed the foundation built by years of effort. Avoiding dumb people does not mean surrounding oneself only with geniuses. It means choosing integrity over brilliance, competence over charm, reliability over excitement. A mediocre business run by honest, diligent people is far safer than a brilliant business steered by fools or crooks. These three enemies, debt, drama, and dumb company, are deceptively simple. They are easy to describe, yet endlessly difficult to avoid in practice. And yet, to avoid them is to tilt the odds of survival and success dramatically in one's favor. It is not brilliance that protects you from catastrophe. It is not cunning or insight. It is the discipline to identify these hazards, the patience to steer clear of them, and the wisdom to accept that avoiding mistakes often matters far more than seeking glory. In life as in investing, these principles echo the same underlying truth. First, do no harm. Avoid the traps that can destroy wealth, relationships, and stability. Avoid the temptations that promise speed and deliver ruin. Avoid people, practices, and situations that compromise your ability to endure. Survival comes first. Wealth comes second. Debt, drama, and dumbness are the silent forces that threaten both. Recognize them, respect them, and you will find that the path to compounding is far clearer than most ever imagine. In the pursuit of enduring wealth, there is a rare and often overlooked force more powerful than any individual insight: partnership. Not a casual collaboration, but a profound alignment of temperament, trust, and discipline. The story of Warren and myself is not one of genius. It is not a tale of brilliant forecasts or miraculous foresight. It is, above all, a story of shared patience. A partnership that endured decades not because of perfect judgment, but because of a mutual allergy to stupidity. Trust is the foundation. Without it, even the cleverest strategies crumble. In a world rife with competition, deceit, and shifting incentives, trust allows two minds to focus not on suspicion, but on action, disciplined, deliberate, principled action. Warren and I never worried about betrayal. That confidence freed us from distraction and enabled us to see opportunities others missed. Temperament, too, matters. The market is loud, chaotic, and often irrational. Without a shared temperament, patience, calm, and the willingness to appear foolish while waiting, a partnership cannot survive. When others chased dot-com stocks in the late 1990s, we sat idle, mocked as old-fashioned or slow. But when the bubble burst, it was our restraint, not brilliance, that protected us. Shared discipline compounds. We refined each other's thinking, balanced risk with caution, and learned to wait for the moments that truly mattered. One partner may excel at spotting undervalued assets. The other may focus on quality and durability. Together, the synergy creates a rhythm neither could achieve alone. Partnership, in this sense, is not a guarantee against mistakes. We bought airlines thinking the industry had changed. We passed on Microsoft when we had the chance. But the crucial difference is that we never made the mistakes that could destroy us. One wrong step does not sink the ship, because discipline and trust keep the foundation intact. It is a quiet, almost invisible form of compounding. Years of shared judgment and aligned principles accumulate while the world is distracted by noise, panic, and folly. Over time, that compounded restraint becomes extraordinary. The psychology of partnership is subtle but profound. A good partner allows you to resist temptation, to act with reason when fear or greed tempts rashness. They amplify patience, temper overconfidence, and protect against self-inflicted wounds. Alone, even the intelligent can succumb to hubris. Together, aligned, disciplined minds endure. This is the hidden advantage in investing, business, and life. Trust and shared temperament produce results that far exceed individual brilliance. Wealth is not created in moments of genius alone. It is built quietly, steadily, by two people agreeing on what not to do, and then patiently waiting for the right opportunities. The partnership of patience teaches a timeless lesson. Brilliance is fleeting. Luck is unpredictable. Patience, trust, and restraint endure. And in that endurance lies true compounding, not merely of money, but of judgment, of discipline, and of shared understanding. In the end, the path to enduring wealth is not a race, nor a spectacle, nor a series of brilliant maneuvers. It is a quiet, almost invisible practice, the discipline of stillness. The universe of finance, like life itself, is loud, chaotic, and insistent. It shouts promises of fortune, brilliance, and speed. Yet, true compounding, the kind that transforms modest beginnings into lasting prosperity, unfolds in silence, in patience, and in the careful avoidance of ruin. The first rule is simple: do not lose. It is not glamorous. It is not celebrated. It may seem dull. And yet, it is the bedrock of every fortune, every enduring success. Loss, especially catastrophic loss, interrupts compounding like a fire consuming a carefully tended forest. Avoid it, and compounding continues quietly, invisibly, steadily. The second rule is merely a repetition of the first. Never forget it. All other advice, all forecasts, trends, analyses, and strategies is commentary. Survival is the framework. Prudence is the lens. Patience is the tool. Everything else flows from these principles. Boredom, long misunderstood, is a strength. The still hand that resists temptation. The quiet mind that waits while others panic. The investor who declines to chase the next hot stock. These are the architects of long-term wealth. Excitement may entertain, but it destroys. Noise may seem opportunity, but it masks risk. Stillness, on the other hand, nurtures growth. Time is the greatest ally. A great business, held with discipline, compounds like a river carving a canyon. Gradually, steadily, unstoppable. The impatient may sprint, leap, and gamble. Yet over decades, the patient reaps a harvest of a magnitude the frantic cannot imagine. Survival is intelligence disguised as simplicity. Avoid debt, avoid drama, avoid the company of fools. Stick to what you understand. Invest in durability. Protect your capital. Let compounding work quietly in the background, like yeast in bread, invisible yet transformative. In every era, the Great Depression, the inflation of the 1970s, the dot-com frenzy, modern speculative bubbles, the law remains unchanged. Those who survive, who endure the storms without reckless exposure, emerge wealthier than those chasing brilliance alone. Wealth is a product of restraint as much as of opportunity. It grows when the mind resists envy, when the heart resists thrill, when the hand resists foolishness. And so, the richest investor is often the one who appears the most ordinary, the most patient, the most boring to the eyes of the world. Yet the universe rewards that stillness. Over decades, that disciplined patience compounds quietly, invisibly, into fortunes that astonish, not because of genius, but because of the absence of self-inflicted destruction. In the quiet, the lesson is clear. Forget brilliance, forget shortcuts, forget the need to impress. Focus instead on survival, on discipline, on the patient accumulation of advantage. Hold, wait, endure, and avoid the temptations that destroy more fortunes than misfortune ever could. To live and invest in this way is to understand the ultimate law. It is not brilliance that endures, but prudence. It is not audacity that survives, but patience. It is not speed that wins, but stillness. And so, after a lifetime of watching markets rise and collapse, of witnessing both genius and folly, the truth is unchanging. Don't lose. Let time, patience, and compounding do the work for you. All else is mere distraction. The stillness of wealth is a quiet victory. It is the triumph of survival over spectacle, of endurance over cleverness, of prudence over temptation. And in that stillness lies the true fortune, calm, enduring, and beyond the reach of chaos.